Now, we're going to be getting the Nvidia earnings next week, but we're also going to start seeing some economic data that we've missed now come down the pike. The September jobs report is going to be out next Thursday. Again, I'll be watching this closely because, again, I told you eventually we're going to see a big negative number come out with the jobs data, and it might be some of this data we missed. The negative number was associated, the negative jobs numbers were associated with the topping process and the sell-off there in 2007. Remember, the only data that we had during the shutdown was the CPI, and they needed that to calculate the COLA for Social Security. We're going to start getting all of this economic data rolling out again. We'll be watching to see what it looks like. Next week, Wednesday, we're going to get the Fed minutes, so pay attention to that, the Fed minutes from the October meeting. This is where Powell said, that don't necessarily count on a December cut. Again, the Fed is still going to cut, and by January, in all likelihood, they're going to be doing jumbo cuts. Now, I tell you what I think. I think it's going to be by January. If I'm wrong about that, it will likely be in the first quarter, but I believe it's going to be by January. If we get a significant decline, which, again, nobody thinks that's possible. Back at the April low, they didn't think we could rally back up. Now they don't think we can go down. That's what the herd does. The FOMC minutes on Wednesday. We'll get the September jobs report on Thursday. If we start seeing negative numbers, again, that could be alarming for the market. Eventually, it's going to happen. Usually it happens right before the recession starts or right as the recession is starting. And I am expecting it to show up. The following week, we're going to have the Thanksgiving holiday short trading week. Black Friday to follow Thanksgiving Day. We'll be watching where we're headed moving into the Thanksgiving Day holiday. Big surge off of the 50-period moving average. A big surge off the 50-period moving average there on Friday. We were up 0.88% on the 10-year yield. Again, we broke out of the bullish falling wedge, pushed above the 50, back tested it, had a throwback towards the breakout. And again, now we're trying to bounce. Again, the yields tend to have a negative correlation with the stock market. And if we begin to see the yields begin to surge, as we've had this bullish divergence, we're now moving into positive territory in the MACD. Last time we had this, yield surged. The time before we had this, yield surged. Back in 2020, 2021, early 2022, we had the bullish divergence on 10-year yield. The yield surged in 2022 and the stock market collapsed. Coin collapsed. Seeing the same thing here. If you look on the weekly chart, you get this large triangle. I think we're going to get Jamie Dimon's crack in the bond market. I think you're going to see yields surge, and I think that will give the market a sell-off. If yields begin to surge, that could escalate the banking crisis. Banks are underwater on their investments. They have massive exposure to the commercial real estate sector, and again, already seen some volatility surrounding sour loans with the banks. Eventually, I think you're going to see the yields end up trying to surge. That will create stress in the credit markets, and I think the stock market will drop sharply. And again, people right now say, what could possibly go wrong? There's no AI bubble. This time it's different. The same stuff we heard back at the 2000 top, the bursting of the tech bubble. And again, this bubble is bigger than that bubble. Bubble is bigger than the bubble from the 1929 crash, top in 1929 there with the crash. This is the biggest stock market bubble in history. Recently at the Fed meeting, Powell was asked, the AI bubble. Oh no, this isn't a bubble. Powell said this isn't a bubble. Back then, that was a bubble. They didn't have earnings and it was just ideas. This time it's different. And the stock market peaked the day that Powell said that. I predicted that we have topped at the Fed meeting on October 29th, 2025. We'll see if that plays out. I think it will. This could be an issue going forward. Be aware of that. Please support the channel. Please support the channel with the link directly below. That allows me to be able to provide you this information. If you could take a moment, partner with me and support the channel today, I would really, really appreciate it. Most YouTube channels are supported with sponsors. A YouTube channel, they constantly contact you. I turn those offers down. I don't want to sell you anything. I just ask that you partner with me and do what you can to help out by following the link below to take you to a secured site, and you can donate any amount you want. If you could just take a moment to do that and step up to the plate to help out, I would really, really appreciate it. Let me know you want this information, that you like this information, and you like my indicators. Just follow the link below, and again, anything helps. I thank you for your consideration for that. Just quickly, the VIX is predicting that we're going to have an update on Monday. 85% chance we will, 15% chance we won't. But like I said, the VIX starts going parabolic. You throw all of that out the window. The MACD firmed up at the center line here for the VIX in the daily time frame. We're bounced off the 50-period moving average. We're holding above the 200-period moving average. You got a little bit of a topping tail as we try to bounce off the 50-day moving average, testing our previous lows. I talked about that, our previous lows from 1 week ago on the NASDAQ and S&P. But again, you're firming up here with the MACD. This is what happens when you get the volatility sharply increasing. I would not ignore this. Stochastic rolled over, turned up, got a higher low, validating a higher low off the 50 period, and it's just below 50. You start pushing above the 50 level on the stochastic, you hold above the 50 period here and continue to try to hold above the 200 period, then volatility is going to sharply increase, or we get a little bit of a pullback and still see it happen. When you're above the 50 period moving average on the VIX here in the daily time frame, bad things happen on the S&P 500. I want to talk about the monthly charts. The S&P 500, it's down 1.55% for the month of November so far. We're halfway through it right now. But it's what I want to talk to you about is, again, I've talked about this head and shoulders pattern. You can see it really well here in the monthly time frame. This is the entire bull market since 2009. Oh, no, the bull market began in 2022. Poppycock. We've had several corrective moves larger than 20% back in 2011, percent or more, 20% there in 2018, 35% in 2020, 27.5% here. Why you've got the people that were telling us the sell-off was never going to happen. They're the ones telling us, oh, that was the bear market and it's over. The people that said it was never going to happen. We're in the fourth year of the bull market, so 2026, this is going to be a great year. Bull market is from back here in 2009. Those were major corrections in the larger bull market. We've likely now completed with the April low and the run-up, the final phase of the blow-off top. In the monthly time frame, we're seeing the stochastic, we're reached extremes, possible a Class B divergence on the RSI with 2 equal peaks there. The second peak is slightly higher, though, just a fraction, but we're seeing the stochastic roll over. You've got a potential rising wedge, and again, you're likely going to see something to happen that will take you back towards the April low. I think you've got a good shot that this head and shoulders pattern is playing out. Hang on, my lines moved on me here. Again, you could come back down and take out the lows from 2022 if that head and shoulders plays out. Again, this is the monthly time frame, long-term monthly time frame. We've found the 50-month moving average acting as support along with the 200-week. And right now, again, you can see ever since we got back above it, acted as support in 2011. We were just above it here in 2016. We slightly violated it there in 2020, but got right back above the 50-week moving average, a green line, bounced off of it in 2022, came down towards it, just above it there in 2025 with our sell-off to the April low. We got the bottoming tails, and now we get the final phase of the blow-off top. If we come back down and we hit that 50-week moving average again and bounce off of it, it'll likely produce a lower high. I'll be looking to see, did we break this trend line right here in the monthly time frame? Break it, come back up, get a right shoulder. Again, I think the Fed will panic by January, and I think we'll sell off sharply. The Fed will panic, and you'll get these right shoulders on Bitcoin and on the S&P 500. They're both forming head and shoulder patterns. But what I think is likely going to be the case. I think you're going to get a sell-off, a rebound, and then again, eventually, I think you're coming back down, 65%, maybe more on the S&P 500. Last two sell-offs, this was 51%. This was 57%. I think you'll see something bigger because S&P is now NASDAQ Junior. And, you got just a handful of stocks. You got about 15 stocks really controlling the S&P 500. 8 of them are the Wall Street darlings that are keeping it artificially propped up. I think you're going to see a bigger sell-off than what we've seen in the past because it's behaving like NASDAQ Junior now. A monthly time frame, in order to have a bear market, we have to take out the 50-month moving average like we did back over here with the bursting of the tech bubble, like we did back over here in the financial crisis. I wanted to bring this up close here a little bit so you can see what's going on. We're seeing the stochastic roll over, and again, I think you're going to get a significant drop here. But one thing I'm really watching is the price oscillator. Now look at the MACD here. This is the MACD. It's moving to a new high. I don't like the MACD as much as I like the price oscillator. The MACD looks at the moving averages. The price oscillator looks at price. If you were to just look here in the monthly time frame at the MACD, you would never see that we have a massive divergence with the 2022 high, and you have a divergence in the most recent price action. You would never know that that's happening. Now, MACD in the monthly time frame is a lagging indicator. We'd never even know that we have a divergence just looking at the S&P in the monthly time frame using the MACD, and that's why I like the price oscillator, the momentum oscillator, so much better than the MACD. Price oscillator, or even the momentum oscillator down here, has the divergence present with the 2022 top. But I wanted to show you this because, again, you've got this divergence in the most recent price action with the February high on the price oscillator, and you've got it back here with the 2022 high on the S&P 500. And that's forming this massive divergence right here that you could see. Just move it up here a little bit. You could see that divergence going on here with the 2022 peak. You know, we're moving to a new high, and you're getting this divergence on the price oscillator, and then you've got one right here from the 2025 high with our peak in February of 2025 before the drop. I think you're going to see a bigger drop to kick off the bear market. That's what has happened in the past. What I think is going to happen here, I think you're going to see a big drop, and I think it's going to be 26 to 30% or so back towards the 50-week, back towards the April low. And I think this head and shoulders is going to begin to set up. And again, you have, when I post charts like this and talk about that we're going to get this big crash to kick off the bear market, people go, oh, there's no catalyst. What could possibly happen? Everything's great. That's what people were saying right before we had the drop from the February 2025 peak. That's what people were saying back in late 2021 and 2022 before we had a 27.5% sell-off. We will have the bear market. I think the monthly chart here on the S&P 500 is warning of that. With the price oscillator and with the stochastic rolling back over, also forming a divergence in the most recent price action. And again, those red bars we're getting on the awesome oscillator in the weekly time frame, I think, are suggesting momentum is beginning to wane here. Now there was all this oohing and awing. Oh, the Dow's moving to new highs. I had people tell me, and it was all over the internet, all over social media, oh, the Dow's going to new highs. Bull market's continuing. And I told you it was a distraction to disguise that, again, we're seeing the sell-off with tech, with AI, the NASDAQ. Somebody tell me, oh, no, we're going to go make new highs. Everything's going to fall. The Dow is 30 stocks. It can be easily manipulated. The NASDAQ and the S&P and the Russell are not moving to new highs. Bitcoin's already collapsed 25%. The market's going to follow Bitcoin. A positive correlation. But look at the Dow monthly as everybody's getting so excited about the Dow. Oh boy, Dow broke out. And I told you it's a fake out, just like what we saw with Bitcoin at the top. It broke to a new high and then it reversed. Look at the negative divergence. This is so bullish on the monthly chart. You've got negative divergence on the weekly chart, or on the monthly chart here on the RSI. And look at the price oscillator here. Again, you've got the stochastic rolling over. MACD's even got a bearish divergence right here. And I like the price oscillator better. Look at the price oscillator. It's diverging with the 2022 high over here, the 2022 peak. And you've got a divergence here in the most recent price action. So again, the Dow also setting up what was likely going to be a head and shoulders pattern heading back towards the 50-month moving average, heading back towards the April low. And I think you'll see some kind of bounce there. I think that's when the Fed will panic and cut by January. And then I think you're going to see this collapse again back towards these pandemic lows over here, right here, either just above them or just beyond them. get something uglier, but that's what I think is going to happen. But again, everybody oohing and awing, oh, the Dow, it's so bullish, it broke to a new high. And yet we've got a divergence going on here in the monthly time frame. I pointed out in the weekly time frame, you got a topping tail and a reversal bar, a reversal in the daily time frame with negative divergences. I talked about that in my last update. In my last update, I showed the weekly and the daily charts of the Dow. Yet people love to drink the Kool-Aid. They love it. Heard more than willing to drink it. And I told you the Dow's slamming into major resistance. But if you look at this chart, this is not a bullish chart. This is a chart telling you that a top is forming. And now we're seeing this month the stochastic begin to roll over on the Dow. If you're one of these people that just bought the breakout on the Dow, you likely just bought the top on the Dow. Heard they love to buy tops and sell bottoms. That's what they love to do. Sold the April bottom, the stock market, and they're buying the top. It's what they do. How about the Russell? How about the Russell monthly chart? This is the Russell ETF IWM monthly chart. It is down 3.55% for the month. Again, look at up here. You've got this rising wedge kind of looking pattern. You've got this divergence in the monthly time frame in the more recent price action with our high over here. We went slightly higher, and then you've got a larger divergence with the peak made in late 2021. Stochastic hasn't rolled over with the Russell monthly time frame, but you've got the divergence down here on the MACD in the more recent price action, the larger divergence with the 2021 high, and look at the price oscillator again. Nice looking divergence developing here in the most recent price action, very much like our RSI right here. Russell bounced at the April low off of this trend line in the monthly time frame from the 2009 low. When the Russell recently peaked in the daily time frame, as I showed in my last video, it diverged with the S&P 500 in the daily time frame. Oftentimes that is the case. Not always, but oftentimes it is the case. Again, just showing you these price oscillators and these MACDs that they're forming divergences here in late 2025 and larger divergences with their previous highs from the 2022 sell-off. Here with the Russell peaking in late 2021. Look at the NASDAQ. Again, the NASDAQ from the high down to the low. It's dropped over 6% so far. During the month right here, we're down 3.29% on the monthly chart that started just after we peaked there in late October. Now you've got a massive rising wedge type of looking pattern here on the monthly chart. If I were to exclude the shadows here from the 2022 low and actually touch the 2020 low, you've got a really nice trend line that we hit in April if you exclude those shadows. So again, I think you're going back towards this trend line, back towards the April low, back towards the 50-week or 50-month moving average. And if I said week, I'm looking at monthly charts. Usually I look more at weekly charts, so sorry if I have called it weekly. It is a monthly time frame. But again, we've got our stochastic rolling over. You've got divergences. Again, look at the price oscillator. The price oscillator is forming a beautiful divergence in the most recent price action. It's forming a divergence with the 2021 high. Look at the MACD. You'd never know that if you looked at the MACD. It's moving to a new high. There's no divergence in the recent price action. There's no divergence back over here. It's based on moving averages, and the price oscillator, the momentum oscillator, so much better than the MACD. You never know a divergence is happening here. Just looked at the MACD in the monthly time frame. You can clearly see it on the price oscillator and the stochastic rolling over. You can see the divergence on the histogram, which is the difference between the MACD and the signal line. Even down here on the momentum oscillator, you can see the larger divergence back over here with the 2021 high. I think the fact that we're getting the rollover on these stochastics now, I think that will allow these divergences. And look at the divergence on the histogram of the price oscillator. Look at that. You have a really nice looking divergence there. When it goes negative, the price oscillator will roll over. Again, it's a difference between the price oscillator and the signal line. I wanted to show you these price oscillators because, again, they're showing that we have these negative divergences in the more recent price action with the February highs in here, that we got a divergence right there on the NASDAQ, and then the larger divergence going back to the 2021 high on the NASDAQ. So again, wanted to show you these monthly charts. And again, just another reason why I believe that we have peaked in all likelihood and will eventually go lower. Now, we do have the gaps. I talked about it all last week. I talked about it in Friday's video. Gaps, Nvidia and NASDAQ, we still may attempt to fill those gaps. We don't have to fill those gaps, but we could. I wanted to show you these monthly charts because, again, this is troubling, moving to new highs and forming all these negative divergences in the monthly time frame. We don't have a divergence on the RSI. That proves that's, well, always get a divergence on the RSI. The RSI, back at the bottom, there was no bullish divergence. We moved to an extreme, and that marked the bottom. Sometimes they form, like at the 2021 top, pardon me. Sometimes they form, but not always. If we go back on the NASDAQ monthly chart, whoops, sorry about that. If we go back on the NASDAQ 100 monthly chart, 2007, there was no divergence at the 2007 top. There was no divergence. There was no divergence back up at the 2000 top on the price oscillator. There was a divergence on the RSI, a small divergence at the bursting of the tech bubble there at the top, but there was no divergence at the 2007 top. None. No divergence. The 2002 bottom, the RSI moved to a new low, so did price. There was no divergence at the 2009 bottom. Sometimes you get a divergence, sometimes you don't. At the 2007 top, there was no divergence. You just reached an extreme, and that was the end of it right before the financial crisis started. We do have divergences on indicators right now, but we don't have one on the RSI. You don't have to get one. You may just end up having an extreme like we did in 2007. I wanted to show you these divergences on the price oscillators and on some of the MACDs. I wanted to show you Nvidia because we're going to be getting Nvidia earnings next week. And again, Nvidia has a gap directly overhead. Maybe it gets filled, maybe it doesn't. We don't know. No requirement that the gap has to fill, but it did gap down at major resistance. I talked about Nvidia in great length and detail in my last update. You can see it towards the beginning of the video, the daily and the weekly charts. Here is the monthly. Look at the divergence that is hovering over the monthly chart here as we're down 6% for the month here in November so far. Now, again, you've got the same possibility here with the broadening formation as the NASDAQ. Maybe it evolves into a head and shoulders. We'll see. But Nvidia has the negative divergence on the RSI. Even though NASDAQ monthly chart doesn't, Nvidia does. And again, it follows Nvidia. Look at the price oscillator. There is a divergence that has developed. It tried to turn above the signal line, and it couldn't do it. It turned right back down. You have a divergence on the price oscillator. Now, the stochastic is rolling over here in the month of November. And again, with the MACD, it's moved to new highs. You would never know that there's a divergence present if you just looked at the MACD, which is based on the moving averages. If you look at the histogram of the MACD, which is this right here, you would see that there is a divergence developing here in the monthly time frame. And again, if that eventually plays out, the MACD will roll over, but it's a lagging indicator and a rotten indicator that doesn't give you the divergences when they actually form on charts. Doing the same thing with Bitcoin. You've got the divergences with the price oscillator, other things in the monthly time frame, but yet the MACD doesn't have a divergence with Bitcoin. It's incredible. I think the MACD in the monthly time frame is a piece of garbage. It gives you really terrible information. This oscillator does a much better job. Let me just show you how rotten the MACD is in the monthly time frame for Bitcoin. Bitcoin's dropped now 25%. It's down 13% for the month. Since I called the top at this trend line, it's now down 25%. The stock market will follow through Bitcoin's lead. And again, Bitcoin's going to end up dropping 80 to 90% as I talked about. But here's the price oscillator in the monthly time frame for Bitcoin. This is what I used. Warned me of the top. Okay, this is the momentum oscillator. Oh, gee, it did a good job too. Here's another oscillator that at least got it right with a divergence. But now look at the MACD in the monthly time frame on Bitcoin, and this is just ridiculous. Look at this. MACD moves to new high. You would never know there's a divergence. MACD is getting the crossover right now. Now that Bitcoin's dropped 25% since I called the top for Bitcoin on October 6th. Did Johnny come lately? Price oscillator did a much better job of marking the top in the monthly time frame. multiple divergences at the previous, notice, at the previous tops. 2021 top over here, 2017 top over here. The price oscillator gave good information. The MACD gave rotten information. No divergences in the recent price action, no divergence, and we even got a divergence in the recent price action, by the way, here from the January high with the price oscillator. No divergence with the past peaks. The only thing you had on the MACD was it reached an extreme. It's a piece of junk. The monthly time frame. I use the MACD and other time frames that don't give useful information, but I'm a fan of the price oscillator, which, just to let you know, Bitcoin hit major resistance. It's now down 25%. Signals warned of a top resistance, and I warned Bitcoin was going to drop down to 100,000 for a test, or bounce out this 98,000 area, or take it out. Took it out. Stock market is going to eventually play catch up. If you don't think that, you're going to have a rude awakening, because you have a positive correlation. Usually, like in 2021, Bitcoin tops first, the stock market tops next. That's what we saw happen before the 2022 sell-off. Bitcoin's about to get a death cross. It may try to bounce while the stock market plays catch up, but again, Bitcoin's lost 0.25% its value, over 25, almost 25.5% of its value in about 6 weeks. I'm still predicting a bigger sell-off for Bitcoin, kick off the bear market of about 40 to 50%. See my latest Bitcoin video. I'll link it at the end of this video. I also did a gold and silver update. I'll link that at the end of this video as well. I wouldn't ignore this. Bitcoin has a positive, longer term, positive correlation with the market. Bitcoin is likely already peaked, as I warning over the last 6 weeks. Market went a little bit higher. Again, they're all hitting major resistance. Bitcoin turned off major resistance in the weekly time frame from the previous highs from 2021, and also with the linear scaling, the trend line from the 2017 high connected to the 2021 peak, first peak in 2021. Again, Bitcoin's likely going to drop 80 or 90%. Stock market follow Bitcoin and get a significant drop in a bear market. Remember, I told you Bitcoin topped on October 6th, right into major resistance. I told you I thought Bitcoin had topped. I told you I thought the stock market would peak right after that. We saw initially the market did peak, S&P on October 9th, and then NASDAQ on October 10th. We took out those highs, went up and hit major resistance. Both of them have peaked so far on October 29th, and again, Bitcoin could be warning that is the top. I think it was major resistance in the weekly and the monthly time frame on the S&P. Talked about that. I think Bitcoin's on its way down for a 40 to 50% drop, 41% if it tests the April low. I think it's setting up a head and shoulders just like the S&P 500. 50% drop, you go down to 63,000. Bitcoin kicked off the last bear market, it dropped 52%. That would take it down to 60,000. I'm just showing you this. It's okay if Bitcoin's not your thing, you don't like cryptocurrency. It has a positive, Bitcoin has a positive correlation with the market, and it tends to lead. We had the sell-off over here. Bitcoin topped before the market, and we had the sell-off. They bottomed together on April 7th. Tends to lead. It topped early over here ahead of the market in January. The market peaked in February. Weeks later, same thing here. We topped October 6th. The market peaked October 29th. Bitcoin tends to lead the market, so it's a warning sign. Even if you don't like Bitcoin, it's okay. You should still look at it because it gives you an idea of what could happen with the stock market, which tends to follow Bitcoin's lead. Enough said about Bitcoin. Wanted to bring that to your attention. Now, Bitcoin may get a bounce as the marketplace catch up. Eventually, I think it's headed back to the April low, or a 40 to 50% drop to kick off the bear market as we begin to move into recession. Bitcoin and the market will collapse, beginning to price in the recession. Banking crisis is coming. I've continued to point out that when we had the top in 2007, again, the Fed was telling us there's going to be no recession. We're going to have this soft landing. And I was so concerned about inflation when they should have been concerned about the recession. Fed making the same mistakes they made in 2007. Here, we began cuts in on September 18th, 2007. The stock market went to a new high. This is the S&P 500, putting the finishing touches on the blow-off top with that. We had the Fed begin cutting back in 2024 ahead of the election. Most Fed chairs don't do stuff like that, but Powell's a really political guy. Most Feds don't mess around with rates right before an election, but that's the kind of guy that Powell is. So he lowered rates and then he stopped. And then he stopped until September of 2025. So the rate cuts were to try to influence the election. I mean, I think it's pretty clear Powell does not like Trump, and Trump does not like Powell. I think that's pretty clear. I think that was a motivation of why Powell did that. Stopped right after the election. A long pause for 9 months, and then rate cutting campaign began. So this is really the start. What we just had is really the start of the rate cutting campaign. The previous rate cuts were purely political on Powell's part. We get the start of the rate cuts in September 2025 here, September of 2007. Market went to a new high. Top 17 sessions later here, we went on a little bit longer than that. We ended up peaking October 29th, exactly 6 weeks later after the Fed began their initial cutting. This is not going to be perfect, but it's very, very similar. We got the October cut in 2007. We got a quarter-point cut. It led to a lower high and a sell-off. Our October cut on October 29th, 2025 also led to a sell-off. Now, this sell-off here in 2007, it was followed by a rebound into the December cut, which gave us another lower high, and that was followed by the crash move into January of 2008. Again, a 20.5% drop. I think you're going to see something similar to that. I think you have more than a 20% drop going into January. I think you will likely drop about 26 to 30% on the S&P. I think it will be bigger than the 21% sell-off that we had from the February high to the April low in 2025. This is kind of the roadmap that I'm following. It's not perfect. Again, the stock market peaked 6 weeks after the Fed. Here it was 17 sessions later, 3.5 weeks later. If we look at the full weeks, but again, I do think we're dropping into, I think you'll get a significant drop going into January. That's when I think the Fed will panic. Now, I tell you what I think. I have the guts to tell you. Most people predict things after they already happen. Tell you what I think is going to happen before it happens. I'm wrong about, the Fed panicking by January. Maybe they do it sooner, maybe by December if we see something significant happen and we get a large drop. It's injecting billions of dollars into the banks trying to stave off a financial crisis, a banking crisis right now. I don't think they're going to be successful, but again, it's a huge red flag and people are just ignoring it, warning you we're about to have a banking crisis, predicting that we're going to have a banking crisis with this recession. And again, I think I'll be proven correct on that. You have to do is look at the regional banks, and they are a mess. They're in a very bad position. They're in such a great position that why is the Fed injecting billions and billions, the largest amount of money into the banks in 5 years? Why are they injecting all this money? Are they taking other steps, as I've talked about in past videos, if the banks are fine? Their banks are not fine. And then the herd go, oh, the Fed's injecting money. This is QE. This is so good. QE. That's how far gone these people are. They're injecting money into the banks because we're about to have a banking crisis, and they're trying to prevent one from happening and prevent it from expanding into a larger crisis. It will not be successful. Why? Because the Fed's policies always lead to negative outcomes. If you learn anything from me, learn that. Fed told us we weren't going to have a recession and there was nothing to worry about back here in 2007 and 8. We ended up having a prime mortgage crisis. We ended up having that evolve into a larger financial crisis. Back in 2006 and 7, they were telling us there's no housing bubble. In 2021 and early 2022, they were telling us, oh, inflation is transitory as inflation was rising to 9%. The Fed is always blind to what's going on because they're a bunch of Keynesians over there. Believe Keynesian economics, you're not going to see anything that's happening in the economy.